Hey everybody, welcome back to the channel. If you're new here, my name is Adam House. I'm a realtor in the Chicagoland area. But today we're going to talk about what happens when you sell a home that's been gifted to you, sometimes by your parents or guardian or someone else. But there are some implications that you should understand before you think about doing something like this. Some people do this if their parents come on to some hard times and need the money. But today we're going to talk about property ownership documentation. We're also going to talk about the tax implications, of course. Also, we're going to talk a little bit about calculating profit. And finally, we're going to talk about and understand what is constructive ownership. This is also something that can come up as well. So without further ado, let's just jump right in. All right, so first up, we're going to talk about property ownership. It's really important to make sure that the ownership was transferred correctly on your deed. Of course, the deed is the document that transfers ownership from one person to another. So you do want to make sure that it was properly recorded and executed. It can clarify and verify any legal responsibilities of anyone that can be considered an owner of that home. And if it wasn't recorded properly, you can definitely have legal implications down the road as well. All right, so next up we're going to talk about the tax implications. It's important to understand how the home was documented on any tax returns. Did your parents claim any deductions on the home after gifting you the home? And please note that usually when someone transfers ownership of a property to someone else, they can no longer be eligible for any deductions federally on the property. It's really important to keep track of all the expenses that were paid on the home, like the taxes, the mortgage interest, or any upgrades that were done to the home as well. The reason for this is that it can offset any capital gains taxes when selling the home. But we'll talk more about that in a minute. Also, if you or your siblings did not treat the home as a rental property and did not receive any income from that, or did not claim any tax benefits that are usually available to real estate investors, it shows that you likely did not have any financial responsibilities on the home. So this is again another place where you really want to have a tax professional help you with this, because it can save you with stress and also money. All right, next we're going to talk a little bit about calculating profit and some other tax information. It's important to understand and figure out the selling price of the home, and after expenses were paid on selling the home, what the net profit was, if there was any, of the home sale. Another thing that's taken into account is how long you've owned the home as well. Another thing is if your parents lived in the home for the last 2 of the 5 years, they can get what's called a home sale exclusion. They could be eligible at least. This can offset capital gains taxes on the sale of the home, which basically means that if you sell the home, you get up to $500,000 tax-free, or $250,000 per individual. That means you wouldn't have to pay any taxes up to that amount when selling the home. One side note here as well is that the Biden administration has proposed basically doubling those numbers. So up to $1 million in profit, or $500,000 per individual, may be able to be excluded from any capital gains tax. It's important also to note that this is just a proposal and it would have to be passed through Congress. But it's a plan that they've decided that would kind of level the playing field by saying wealthier people can pay more in taxes, and this would make everything a little bit more fair for everyone. All right, so next we're going to talk about constructive ownership. This is a concept that even if your name does not appear on the title of the home, you could still be liable for any capital gains taxes when selling the home. So to help with understanding this, there are some questions that you need to consider. Was there a clear understanding by all parties involved that you and or your siblings were the owner of the home? Did your parents refer to the home as yours, and did you assume all responsibilities and expenses related to the home? Answering these questions can help you understand if constructive ownership applies to your situation. And lastly, we're going to talk about some alternative solutions. One thing is that you could just rent the home and earn a little bit of that income on the home. That is, of course, if you don't need the home right now. Another option is to live in the home. If you want to live in the home and you live there for two years at least, you could also qualify for the home sale exclusion on the capital gains taxes, so that when you sell the home, this won't apply to you then. Another solution is you could just give the home back to your parents. This would also exclude you from any capital gains taxes because it's technically not selling your home. And so, in conclusion, selling a home can have financial and emotional benefits, but it's crucial to understand any of the tax implications. You need to understand the property ownership documentations, the taxes claimed, any profit from the sale of the home, and of course, constructive ownership. Again, hiring a tax professional to help with this and figure out your specific situation can bring you a lot of peace of mind as well. And that's it for this video. Please hit the like and subscribe button. It really helps me make more videos to help more people. And also please comment in the comment box if you have had any of these situations apply to you as well. I'd like to know if there was anything I may have missed, and we can help spread some knowledge. And I also hope to see you in the next video. So I'll see you later.